Good morning, everyone. Welcome to another terrific Tuesday morning. Welcome to Wealth Coffee Chats. Good to see you. A few of the regulars already in the house, which is great. We've got Luke there. Morning, Luke, Alison, Mick, and Aaron. Hey, good morning. Good morning. Good morning. Hope you're all well, wherever you are. Why don't we just do some little warm-ups for the moment, folks? While we're waiting for everyone to jump on the live stream. Jason Whitten's my name. Most of you know that, but some of you may not. So there you go. Now you know. Now you know. Each morning we could get together and have a cup of coffee and a bit of a chat about what's going on out there in the world of property investing. Plenty happening all the time. Australia certainly likes to invest in real estate, and we certainly like to talk about it a lot. Newspapers, media, opinions, plenty fly around all the time. But how do we sort out the real deal? The stuff that's important to us, folks, the fear from the fact. Well, hopefully that's what these mornings are all about for you and I. Bit of a get-together, bit of a chat about what is happening just to keep us on track. Daily adjustments or daily tune-ups rather than monthly, quarterly, or yearly, I think work quite well in this sort of space. We're creating some wealth with our real estate. So, yeah, that's the gist of the show. So welcome along. Fantastic to have you here. Morning, Kevin. Good to see you, mate. Let's dive into today's show. I thought we might talk about the three phases of growth this morning, folks, and talk about why it's important what happens with growth. Not only, we wanting to buy and own some real estate so our wealth over time improves. We want to do something with it. And there's a few stages, there's a few bits of those stages of growth. There's some things that we want to occur, some things that we want to have happen as property investors, and how does it arrive there? What makes the property values go up and or down for that matter? Well, let's chat about what that might be. You guys have seen this one, as we have had plenty of conversations around the three phases of investing, which is the acquisition phase, where the idea we need to get into it and buy some property. There's the consolidation phase where, let's face it, we've done our investing. We may have purchased a number of properties. We need to sort of let them sit a little bit. We need to let them grow. We might need to add some value. Plenty of things to do at that point in time, folks. And the last but not least, the part that we're all interested in is the lifestyle phase. The phase, folks, that when we get out there and about, we're looking to get some value from our investments now and into the future, mostly into the future. Most of us know that residential real estate's a slow-moving vehicle when it comes to wealth, quite powerful over time. What are we looking for, though? We're looking to buy and see our values grow. Often when we first start out, when it comes to this gig called property investing, though, we might have our loans. Our loans are a little bit higher than our property values, especially if we're using sort of equity and whatever it might be. And our cash flow might be kind of in the middle. And we want our cash flow to increase over time as well. Ultimately, this is where the wealth, the dollars are created down here, where the gap of wealth is between our debts, which are low. After 30 years, our debts are paid off. Anyway, if you run this gig properly, and then we end up with some choices. Now, can we make it? Can we bring it forward? Can we make this happen faster? You know, this is kind of a plan we talk about all the time. This is 15 to 20 years minimum, and then 20 to 30 is where it sort of kicks into gear and, you know, makes the world go round. This is kind of the first 5 to 15 years in this sort of acquisition, consolidation, lifestyle phase, you know. But what really drives the growth in this section here? What really drives the growth? And what is growth for? What is growth for? What is it for in the different sections, folks? What is real estate growth for? Well, let's talk about that. That's the conversation today I want to have with you guys. And let's see what we can do in this property investing gig. All right. Hopefully that lays the foundations of this morning's conversation. So, a few of you on the live right now. So tell me in the chat, what is the in the acquisition phase? What is growth for in the acquisition phase? What do we use capital growth for in the acquisition phase, folks? What's its number one thing that we want our properties to grow in one way, shape, or form in the acquisition phase? What's the growth designed to do? What do we need that growth to do for us as investors? We don't have endless amounts of access to cash and capital, and growth is important in the early stages, in the first 5 to 10 years, to do something pretty important, right? To buy more property, exactly, Mick. And more specifically, it's return the deposit, or to be able to reuse the deposit multiple times. Okay. Yep. Equity. Yep. Equity, Aaron. Our properties grow. We create equity, but we can release. Hey, Jeff, how are you, mate? Oh, yeah. Good. Mate, Sam's heading down to Melbourne for the bus tour as well, Jeff. So if you haven't got yourself on the bus tour, make sure you do. All right. So return our deposit, folks. This is its number one gig in the acquisition phase. The number one thing of your property's growth value is to return the deposit. How can we do that? What's the early stages of acquisition, that sort of first 5 to 15? What's going to drive that value? Well, let's go and have a look at some of the things that we believe will drive the value. Now, if we focus in here to Sam's 4X growth plan, sort of over a 15-year growth plan, there's 3 phases. There's 3 bits of property growth that we have seen and experienced time and time again drive capital growth for property. Number one, the deal itself, how you do a property deal. And we'll talk about that in a second. The location of the property. What type of deal do you do? And the location. You get the location growth, where you purchase. The proximity to things. What's happening in those locations, et cetera, et cetera, et cetera. Now, that's an important one, that is for sure. But the big kahuna, folks, the big one that drives the majority of growth is market growth. And that's driven by large influences, billions and billions of dollars, millions and millions of people influencing these things. So let's look at it. Let's have a bit of a sticky beak of what we can have a look at. Deal growth. This is usually from kind of 0 to the first 3 years. You know, how can we drive some growth out of a property deal? Well, number one idea is to use other people's time. How do we use other people's time? Well, You can buy off the plan. You can delay a settlement. You can land bank, things like that. I won't dive deep into that idea today, but you can go check out the mentoring group and you can have a look at people who've purchased off the plan in a cycle. They purchased it for $650 and now it's worth $750. They didn't have to pay anything while they were waiting for that property to complete, and they got an uplift. Okay, time can be very valuable in the way and the early days of buying a property. So you can drive some immediate instant value when it comes to your capital growth. Discounts, right? You can get some immediate value, buy something at a discount, folks. Plenty of people, hey, you're trying to sell it for $650. How about I give you $600? How about, $590? Those things. Right now in the marketplace, a little bit less discounting because the market is a little bit more favorable to the vendors rather than the buyers. But, discounts are there. Vendor rebates. You guys have seen these things happen plenty of time. Other people's designs. Designing and building a very funky, nice house, knock down and rebuild an old house in a really good area, but the land is quite large, amalgamating things, putting two pieces together, etc. And we're getting down to where you're sort of adding value now. Like we're getting down to getting involved in some developments, maybe turn one house into a duplex. Renovations are popular. Buy an older place, add value, maybe put a extra bedroom in, renovate and fix up the property, subdivide, et cetera, et cetera. This is how you can add value when you buy the property, folks. When you buy it, okay? At the beginning, at the start, when you buy that property and, 10 to 15% instant growth or instant value is often not unheard of when it comes to the early process of purchasing a bit of real estate, okay? So in the early days, let's have a look at, what that might look like when it comes to here. If we purchase our property and we bought in the acquisition phase, it's returning the deposit. The type of property deal, the type of deal we do can drive that deposit back to us faster, okay? How we do those deals. Number one, it's an important one to understand. There's two types of properties you can buy, or property, styles you can buy. You can buy an existing property, or you can buy an off the plan or a property to be built. There's brand new and there's existing, right? So either one, perfectly fine. Both work extremely well, and both of them, all of these ideas apply to either style. Okay, this is residential, by the way. Residential. How are we getting our deposit back? Okay, when it comes to that one. So the discount or the deal growth, folks. The deal growth. Okay, let's have a look at the. Oh, come on. All right. Okay, the deal growth. That's how we're getting our deposit back there. Okay, let's look at the location growth. Location growth is about how and where we're purchasing these properties and what's going to drive those areas, okay, for growth. Gentrification. Sam dives deep into that sort of stuff. Older areas now close to cities used to be, a little less desirable. Everything else has been filled in around them or fixed up around them. And now they're being fixed up. They're the sort of the cheap, new up and coming area. Emerging land markets where there's brand new estates. Land developers like Stockland are fantastic for this. They buy, a big bit of dirt and they build schools. They put in railways. They put in shopping centers. And those are fantastic. They're master plan communities. And it's driven by sort of infrastructure when it comes to that location. Rare earth, all right? Things that are tightly held. Sam showed a property the other day at mentoring. Lady bought it for $50,000 in 1970, I think, 1970. and she sold it for 50 million, like crazy, but rare earth. Waterfront, like in prime real estate in Sydney. So, that sort of stuff. Limited supply, NIMBY suburbs now, where, there's no development. It's completely constrained when it comes to supply, and the wealth of that suburb grows. High incomes, high net wealth, etc. And, growth from aspiring middle ring suburbs. What's the middle ring conversation? If you haven't heard of it before, it's called, the ripple effect. So ripple effect right now, if you go to Brisbane, a perfect example of the ripple effect is a suburb called Pallara. We were helping people buy properties there for 400, 500. Now those properties are 800, okay, in Pallara. Nothing wrong with that. Fantastic. Happy days. It's driven by certain things. Perfect, So location growth. Location growth takes time, folks, all right? That's 1 to 0 to 3 years. This is kind of where location growth is going to give you some location growth is going to give you some longer periods of growth, like over time. So the Pallara story played out over a 5-year period. Okay, so if we talk about that, so if you think about and now, the next few years are going to be driven by location, not location growth, but the market growth. Things like population, infrastructure, employment, demographics, supply and demand, yield, and market timing, right? Things like interest rates and other bits and pieces. That's going to drive large growth over time, right? So if we look at our consolidation phase here, and we're looking the acquisition bit, the number one reason for growth is to get our deposit back. How many times can we do that? What's the type of mechanism can we deploy in returning our deposits as fast as possible? Let's have a bit of a look at some numbers. I always like to, have a look at the calculator. And I've chucked in here just a quick, simple idea. Property for 650. I'm putting a cash deposit in because just makes the numbers easier to look at on the 10-year report. 650, blah, blah, blah. Now, this is all about the return of the deposit, not about the cash flow at this point in time. So let's look at this. We've got no discount. There's no instant value based on any of our initial factors. We're just saying that property might grow at 4% a year. How long will it take for us to get our $150,000 back out of that property? We put in 150 to do the deal at an 80% loan to value ratio. How do we release the deposit out of a property we already own, folks? Well, that is a function of finance. If we're not talking about selling it, by the way. Don't sell it. So if you look here, how quick does our property just based on longer term factors, 6 years, okay? If our property grew at 4% a year, then it's going to take 6 years for our deposit to come back. Nothing wrong with that. That's fine. Is that the end of the world? No. What happens if it grows a little bit faster? Okay, what happens if it grows at 6%? Let's have a look at that. If you bought in an area that grows at 6%, well, it's the difference between buying another property in year 6 and buying another property in year 4. Everyone understanding that? Now, what can speed this up, folks? What else can speed this up? Well, you can have multiple properties, all right? Every time you buy another property, let's say you've got 2, you purchase the next one in year, let's say you purchase the next one in year 4, and let's say this is linear, you purchase the next one in year 4. Now, how many properties have you got going to work for you? You've got 2, maybe even plus your owner-occupier. How quick can you get the next deposit together? Well, arguably, if it's all linear, The first one was just 4 years, and then there's the third property after you bought the second one is now 2 years, right? So you can see how the compounding effect of you can get those 4 or 5 properties a bit faster, and it's the hockey stick that goes along. What else can drive that? What else can push that along when it comes to, how quick can we get our deposit back? Let's have a look at this. Well, let's see if we purchased the property and we got a discount. Let's see if we got the market value was 650, and let's say we purchased it for 600. Let's just say that. Let's say we got a $50,000 discount, folks. How quick can we get our deposit back over here? Oh, beautiful. Well, listen, we got it back a year earlier. Isn't that awesome? All right. So think of that idea as we go through this conversation. As we go through our our phases of investing, how quick can we get our deposit back, which is important to appreciate and understand. Well, let's have a look at this. If we purchased, let's say, the simple one's a discount, by the way, but it could be any old or any style of creating equity. Let's say we purchased at a discount, we got 10%, and then the location growth added 2% a year, and then the market growth even at sort of 3% a year. Let's just call it 3 and 3 is 6. So you can see the compounding effect. 10% discount plus the compounding effect of those two things creates the version of getting our deposit back. Anyway, there you go. Did that make sense? Right? That makes sense. These factors, deal growth, location growth, market growth, we need to understand. The big kahuna, the one that's going to make us the most wealth, folks, is market growth. All right. Over time, you've done the deal. You are owning and keeping your property. And over here, this is where your wealth is going to come from. And as the market grows, it's going to continue to push the value of your properties over time. All right. So there you go. Well, a little bit technical this morning's conversation, but I thought it'd be worth having a bit of a conversation around that when it comes to where does your growth come from and what's it for? The point is, the first stage is to get your deposit back. The second stage could be the growth could be used for debt consolidation. And the third stage, the growth can be used for lifestyle. And how can we live off growth? Well, I might have we'll have another Wealth Coffee chat about that sometime soon. If you're up for it, let me know in the chat. You want to know how to live off tax-free off of growth in the future. There, we will have a bit of a Wealth Coffee chat about that one, folks. Anyway, there you go. That's it. Done and dusted. Wealth Coffee chat over and out, folks. That's it from me today. Thanks for joining me. Remember, we get together at around about 8:10 each weekday. This Thursday and Friday, I'm not going to be around. I might get a guest along to take over the Wealth Coffee chats this week. We'll see. Let's see what's going on. All right, folks, that's it from me. Thanks for joining me. Remember, a couple of sayings around here. This thing's a marathon, not a sprint. It's going to take some time. Buy well, don't sell. That's the point of this whole kit and caboodle. Purchase and keep your properties. All right, folks, that's it. Done and dusted. Thanks for joining. You guys take care. See you tomorrow. Bye for now.